Okay. I think we should just go ahead and jump into it because we do have a lot to cover. Good morning and good afternoon to all of our East Coasters. And welcome to another Tidbits for Note Investors. It's not lunchtime tidbits anymore, it's just tidbits because we do have many people across the nation who are joining us. And I want to thank everybody for coming. As you all know, that we've decided to change everything from Thursday to Saturday. We're still kind of testing this out, but if you guys have any comments or suggestions or concerns, please let us know. We want to make sure that we're in the right time spot for you guys. At the end of the day, we make time to do this for you guys, so we want to make sure that it's being done to your needs and fits your schedules. With that said, for those of you who are just joining us, my name is Joe King. I'm one of the co-founders of Revival Brothers, and I will be your co-host today. And I'm joined with none other than the godmother of notes herself, Saprina Allen, who will be speaking on today's topic, why is RESPA so important to note investors? And we'll be covering the different sections and the ins and outs of that. And we're gonna potentially spread this over 3 different webinars. So this is gonna be a 3-part series. And then also for those of you who are just joining us, this webinar is specifically for note investors, and it's designed to give you different information every week focused on note investing. So our goal is to take a look at our day-to-day businesses, pull out case studies and pull out issues and topics that occur and present them to you so that you guys can get more of an inside feed on note investing. With that said, again, our topic today is why is RESPA so important to note investors? And before I turn it over to Saprina, I just want to say that earlier this morning, we sent out an email through social media, and the email was related to 4506T and 4506C forms. And we in that social media content, I actually put a link to the new form through the IRS. So if you guys want to check that out, go to it, download it, save it, and you can utilize it. I'm going to let Saprina talk a little bit more about those forms. And then also before I turn it over, I just want to thank our sponsors for making this all possible. Again, M2 Trusts is an IRA company. They do a lot of retirement type accounts. So if you're interested in doing like a self-directed account for note investing or any kind of investing, you can give Belinda Savage a call. Her number is up on the screen. The website is also up on the screen. I also want to thank the Art of Notes, Revival Brothers, the Leaders of Integrity, LOI Events, Prolific Realty, the Ideal Property Analyzer, and Note Inc. And with that, I'm going to go ahead and turn it over to Saprina to talk a little bit about the 506 or 4506T and 4506C documents.
So again, happy Saturday, everyone. For those of you who don't know what the 4506T is for, it is actually for, it's an authorization that's given by the borrower or the taxpayer. They sign an authorization and you send that in to the IRS, and you can actually get a transcript of their taxes. So why is this important to you as a note investor or someone who's doing seller financing? It's because you actually get to see what the borrower is doing, and to make sure that they're telling you the truth. They can tell you that they've had a loss of income for the last 2 years, but how do you prove it? This is one of the ways that you can actually prove if their income has been the same, if it's been a loss, if they're self-employed, whatever the case may be. When you need their transcripts, this is how you actually would get it. And we generally put this in the hardship package. And we haven't really talked about mods or hardships lately, but this is kind of a good way to kind of go into our topic today, which is RESPA. And I don't have any slides prepared for you guys. I'm sorry, but I do think that RESPA is important. And I think that as note investors, we have just focused on the hello and goodbye letter in RESPA. That's all you hear people talking about. And I think that that's what's been drilled in our heads. So that's all that we focus on. And we don't think of violating RESPA any other way in the note industry other than hello and goodbye letters. And what does that look like? And making sure that the hello and the goodbye letters are approved. But it goes deeper than that. So RESPA actually has 4 different sections that really pertain to us. Section 6 is servicing. That's really the division that really focuses on us. Section 8 is about referrals and kickbacks. Section 9 is about, using a title agent, and Section 10 is escrow. I'm still going to only focus on the servicing piece today, but the servicing piece still is just greater than hello and goodbye. It's about how we're handling our foreclosures, how we're handling, escrow accounts, how we're handling our modifications. And those are things that I think that as investors, we don't really think that we have the ability or the exposure to violate RESPA once we get past the hello and goodbye. And there's still things that if you're not doing during your modification process or your forbearance process, you could be violating RESPA. There is RESPA is governed by the CFPB. So, that is the officer, the overseer of what we're doing. And we know that I say the CFPB might be bored right now because they haven't been able to do a lot. But right now, I think that this is a time where they could just basically get out of control. And I still think that the small guys are going to be the ones that's going to get punished. It's not going to be, the big banks if we don't, start thinking differently and doing our business differently. Just to kind of give you guys some insight or some ideas about the fines that's attached to violations of RESPA. Damages are not to exceed $1,000, but in a class action suit, penalties can be up to $1,000 for each member. Total damages not to exceed $500,000 or 1% of the net worth, whichever is less. So 1% of your net worth is quite a few notes. It's not about what's in your note business. It's about your net worth. So depending on how you've structured your business and you don't have those layers of protection in place as we've talked about, series LLCs, trust, how you've done your investing, if you've done your investing in multiple different ways, I think that there's multiple layers and levels of exposure. So let's talk about just service transfer. Somebody had the idea of combining the hello and goodbye letter together. And Joe just actually pulled up, RESPA, and it's 67 pages, and that's in fine print. And if you want to, I'm blind, so, that's probably 150 pages because you got to blow it up so I can see it. I'm just kidding, Joe. But this is just an example of what RESPA looks like. And it's a lot, and it's about the settlement procedures. And when we're buying loans, and as I went off on a tangent about somebody decided to combine the hello and goodbye letter, and does that meet the regulations of RESPA? Well, I think that it may fall on who's the official or the investigator who audits your file, if that's acceptable or not. So stop cutting corners, have your seller do the goodbye letter, and make sure you do the hello letter. And if you don't know how to do a hello letter, maybe you should not be servicing your own loans and you should be using a servicer. Just out of curiosity, anybody want to come off of mute and talk about their servicing experience or service transfer experience?
Go ahead. Yeah, go ahead and raise your hand if you have any questions.
If we have any questions or have any voluntary participants.
See any hands going up? So
no.
I would assume that not a whole lot of people know about RESPA because they leave it up to their service. Oh, we do have one hand. It just went up and down.
Who was it?
Cindy always raises her hand and then says, "Oh, my computer went haywire." Well, let's see if she actually has a question.
Take her off mute.
There we go. Hey, Cindy.
I actually just have a comment, and it's like, I totally rely on my servicer, which is One Main Street Asset Solutions. Thank you, Saprina. You are my go-to person, and I have never had an issue. Their hello, goodbye letters are spot on. They're out on a timely basis. However, I have worked with prior servicers, names unmentioned, of which letters have never gone out. And when asked about it, it's like, oh, that's something that you have to ask for. And I'm like, what? So anyways, my comment is like, just, be aware of who you're working with. Again, my go-to is One Main Street Asset Solutions, and Saprina, your company has done a fabulous job. So it's just a comment.
Okay, thank you very much. And so the other thing is that, there's information that has to go in the goodbye letter. There's information that has to go in the hello letter. And I can't say that I feel like I'm dumbing this down, because as Joe just stated, that everybody doesn't know about RESPA. So I guess I probably should have done some slides, just even the simple information that needs to go on your goodbye letter and your hello letter. And generally, you have to say, it's 15 days that you actually have to, you have in between. So you say hello and you say goodbye within 15 days. That letter, the hello letter can go out sooner once the goodbye letter has gone out, but you need to make sure that the dates match and all the information is correct. So what do I mean by information being correct? The goodbye letter basically states that your loan has been sold or the servicing rights have been sold. It just depends, because sometimes ownership doesn't change, just the servicing changes. And it needs to state who the new servicer is. If it's different than the investor, it has to have a phone number, a fax number, and that phone number needs to be a 1-800 number, not just the phone number. It needs to be a 1-800 number, because technically if you're servicing debt, you have to have a way for the borrower to be able to call you that is that's not going to cost them anything. So you have to have an 800 number, a fax number, hours of operation, and days of operation. Those are the key things that need to be in there about you as the investor. The other thing that I will say that it needs to be in there, it needs to reflect the loan number. It needs to reflect the address that you have for security, or as collateral. And sometimes, not always, it does have the loan balance. Sometimes it's on there, sometimes it's not. And I would recommend that it should be on there, because once the loan is service transferred, one of the other things that normally sometimes triggers, and we're not going to talk about it today, it actually triggers a QWR, which is a qualified written response. And if you don't kind of disclose that information initially when you transfer the loan, it just creates some, I'll say it creates some conflict on what that balance could be if they actually hit you with a QWR. And you do have to think about, borrowers are getting to be, they're more sophisticated, they're more savvy. And sometimes if nobody's reached out to them in 5-6 years, they think they don't have to pay that loan anymore.
We have a question here from Sri. He says, original UPB or current UPB? And I'm assuming
Current.
that's, okay.
It's the current balance.
Okay. And then we've got another question from Marco. Saprina, would you mind touching on boarding newly originated seller financed loans with a servicer and RESPA requirements?
I think that we'll hit that with part 2 maybe next week, if you don't mind, Mark. Because that's a little bit different in reference to stacking order, in reference to also some of your compliance pieces, depending on how many loans you're originating, different things like that. But that is something that we are going to talk about, because I don't know, people just think that they're exempt. They don't have to follow the rules. And especially when you're converting a loan from a REO to doing seller financing, what is your exposure? Those are the things that you need to ask yourself about. And then, the other thing that, I want to touch on today, because it's already 1:21 and we're trying to wrap these up in about 45 minutes. So they're not, so we're not taking up all of your time, is escrow. Loans that you're having escrowed, what does that mean in reference to keeping payments, doing your escrow analysis on an annual basis? Are you sending out the proper disclosures? Are you sending out the proper notices when when the payment has to increase? If you guys aren't doing that, you're violating RESPA. So what that means is that if you choose to escrow an account, once you modify it or put it into a forbearance agreement, you are required to do some analysis. You are required to send them notice 2 months before the payment adjusts, if the payment is required to adjust, because you have them on some type of a stair step in their forbearance agreement or their modification. If they're the escrow shortage, how are you handling that? Are you doing a corporate advance? Are you advancing that money because they're short? Are you giving them the proper notices to let them rectify or to make their escrow account whole?
Cindy had a follow-up question here. If I buy a note and I leave it with the same servicer, is there still a need to do a hello and goodbye letter?
No, it's not. You're not required to, because the servicing of the loan is not changing. Ownership is changing, but servicing is not. So that means that they're not going to get a statement from a new lender. They're not going to get, we're not required to do that at this point in time. And so sometimes your borrower doesn't even understand, or they don't even know that the investor has changed. And what I mean by that is that they don't open the mail. They don't know that they might have the opportunity to start making payments on their loan again because they've been told no by the previous investor. And a lot of it, even though we're required to send the disclosures and we're required to send the letters, a lot of the borrowers don't understand what it means, even though RESPA was created to protect consumers in reference to anything in reference to the real estate transaction or in reference to the property. Even though RESPA was created to protect the consumer doesn't really understand how they're protected. And we as service providers have not done a good job on informing the borrower. And I mean, we follow the rules and sending the disclosures, but there's not conversations that we have with the borrowers to inform them. And everybody thinks about, well, it's not my responsibility. I would rather have a conversation and explain to a borrower what's there to protect them versus them going to the CFPB and the CFPB enforcing that protection. Or someone telling them on Clubhouse, as I heard someone telling a borrower the other day, well, just go file a CFPB complaint. I don't know that I would do that on a public forum, but on a case-by-case basis, if I felt like somebody was really and truly in trouble, I might suggest that they file a CFPB complaint And I don't know if you guys are aware that once a CFPB complaint is filed against you, it's public record forever. There's not been anything put in place where it has to be removed. Whether you're guilty or not, that CFPB complaint remains public. And so if somebody wants to go search you on the CFPB's website for any type of violations that you have made or any claims against you, they can actually see what that is, and they can also see what the results were on the CFPB's findings.
So, back to the penalties. One of the things that I was reading a while back was that you could also go to jail, right? I mean,
yes, you can. 1 year in prison.
1 year in prison, right?
Yeah.
And up to $10,000 or something like that. You had mentioned something about 1% of your net worth too.
So it depends on what section of RESPA is violated, though. So the prison, the imprisonment is under referrals and kickbacks. So referrals and kickbacks. Okay, you guys, we all kind of scratch each other's backs. We all kind of do things. And so this is more on the origination side with the referrals and kickbacks. But depending on how we're doing business and depending on, that's why it's really important to have a broker fee versus somebody just basically giving you money for giving you a note deal, because we are dealing with secured assets. So you just sending me $3,000 after I send you a deal, but there's nothing really lined up about what my fee was. That could be interpreted as a kickback for me giving you actually assets that are secured. It's just the interpretation of whoever's looking at it. So it's always good to, to get an invoice from your broker or get an invoice from whomever you are actually buying loans from. Just another layer, because we don't know how they would actually look at some of the ways that we do business in our space. And then that's a really great area, but the kickbacks are more on the origination side, as an example. So I see Frank Evans is on. And so I own a broker shop, and I actually pay Frank $10,000 to refer all of his clients that he's working on estate matters for, to refer them to me to do reverse mortgages. So those are the kind of things that that RESPA actually covers and governs. And the reason that is, and that's because, back in 2008, when all of these loans were being, created, there were a lot of monies being exchanged, a lot of straw buyers, a lot of people getting kickbacks for referrals. And that's just not allowed anymore. It's not permitted.
So is the CFPB the governing entity behind it? Like, for instance, if somebody were to report a violation, would it go to
yes.
them? So
the CFPB actually governs RESPA. And so there's state regulators, but when state regulators are in place, I can't think of the name of the word, but there's state regulators that are put in place to kind of oversee what's going on with the state. But when the state is creating rules and regulations for people to operate in, they kind of have to still mirror the federal law, because federal trumps state. So you could also, people could file a complaint with you with the Attorney General, but depending on what the Attorney General finds will depend on where the investigation goes.
And how does HUD play into all this? Or does it?
So HUD doesn't play into RESPA. HUD is more TILA.
Okay. But TILA and RESPA, there is a TILA RESPA.
Yeah, it's a combination, but I think that there is a line in the sand, and it's not gray. It's very divided. So what happened with some of the disclosures on the origination side? TILA and RESPA combined some of those disclosures because they were saying the same thing, doing the same thing, serve the same purpose. But RESPA is a beast of its own. It's one of those things. It's like social studies or government or civics. It's one of those subjects that, I have to do it, but I don't want to do it. It's kind of one of those same things. And I just have a question. Does anybody know how much money over, once you do your escrow analysis, how much money over the escrow analysis that you need, you're allowed to keep in reserves over what the borrower actually has in their account? So if I have
how much should you keep, or how much do you keep?
how much that should you keep? How much are you legally allowed to keep?
I didn't know there was a legal number on that.
It is.
Oh, okay. I have no idea what that is.
You are allowed to keep I think it's 1/8 over the amount that's due, or 2 months. So you're allowed to keep 2 months in reserve plus 1/8 over that in case there's some form of an adjustment. But other than that, you're not allowed to keep any extra money in those accounts.
Interesting.
Anything over $50, you're violating.
Over $50.
Yes, so you have to then communicate with the borrower that the money is in the account and what would they like to do with it. Would they like it applied as a principal payment on their account, or would they like a refund check?
Interesting. Well, we have another question here from Eddie. You mentioned that some borrowers, after a long period of time, feel they no longer have to pay. In your experience, have you been able to find a way to get the borrower to re-perform, to stay in their home, or do you find yourself taking them to foreclosure?
Well, I think a little bit of both, Eddie. I have been able to sometimes convince them after I start foreclosure that I have the legal right to collect on the debt. I don't know if Brandon is on here or not, but I think it's Brandon Campbell. He has a case right now where the borrower is stating that they did a mod some years ago, and they thought that the first and the second was combined. So Brandon's a seconds guy. And there is nowhere in the mod that states that the first mortgage and the second mortgage were combined, but that's their argument, and they've retained counsel. So now, you have to pay for litigation. And I think this attorney wanted $3,500, $4,000 just to represent the litigation piece of this on top of the foreclosure fees that have already been paid. So again, it can be quite expensive, even trying to enforce what you have a right to collect. Sometimes, people will say, well, I just didn't know who to pay, so I stopped paying. I had a case a couple of years ago. An investor just was chomping at the bits, thinking that he was getting ready to get this $250,000 home, and the balance was maybe $14,000, $15,000. He had been out to the property. He saw that it was vacant, and he just thought he had a home run. Soon as that hello letter went out, the borrowers called and said, we've been waiting for somebody to reach out to us so we could pay this off. They paid the loan off in full.
Have you heard of the TRID rule, TRID?
Who is that from?
It's not from anybody. It's just something that I had read, and I was curious as to what exactly it applied to, and it has to do with providing loan estimates to consumers and the way that you do that and the process.
So the TRID rule in reference to loan estimates is that once a borrower signs the application and has the intent to proceed with their loan, they have to have a loan disclosure given to them. And basically that loan disclosure, that loan estimate it has to have what they're paying for the loan, the cost of the loan, projected taxes and insurance, if they're paying for any points. That's more on the origination side. It's not in a world where we are in reference to note buyers. So what I don't want to do is I don't want to confuse our audience by talking about TRID and TILA and RESPA, where they just really are confused. And that's why I said I probably should have had some slides put together so people could really, really see in those numbers in reference to violations of what the fines are. they could actually see it. Because sometimes hearing it, it doesn't sink in. But when you see it, when you see what those fines are and what those consequences are, it makes you think differently. But I do hope that this makes us as investors think differently about, reserve accounts and escrow accounts, and even in reference to serving proper notice in reference to doing our modifications and our forbearance agreements and collecting the proper information and the proper documentation before we deny those. Because if you don't, you could be possibly violating RESPA.
And how would RESPA know that you're violating anything? Is it something that they would have a complaint would have to be filed in order for them to audit? Or an audit? But what are some of the triggers for the audit, I guess? Question.
Well, so some of the triggers for the audit is just annual audits. State audits. A state official can come in and audit the loans in their state and see that you violated RESPA by looking at your collection notes and actually looking to see what you've actually done in your files. That's a trigger.
Okay.
So if you don't have your loans with a servicer, then your loan may never be seen unless somebody files a complaint. But if another thing that I think that is a challenge, as as investors, the servicer reaches out to us, gets permission to do A, B, C, and D, and you don't respond, or there's a delay in the response, and now we've gone over a time frame and we haven't responded to the investor, and not the investor, but the borrower. So that could create a trigger of a borrower filing a CFPB complaint because we haven't responded. We haven't said yes, we haven't said no, but you're leaving a borrower out there kind of on edge, and they don't know, I don't know if my modification is going to be approved. I don't know if my forbearance is going to be approved. And you guys, we talk about, papering up, making sure that you do the right thing. But in doing the right thing, we talk about the net tangible benefit for a borrower or for a consumer. Make sure you're collecting the proper documentation. And if it doesn't look right on paper in reference to what they're able to afford, when you put them in some type of a mod or forbearance agreement, see where the money's coming from. Ask them to write a letter stating that they have their brother living with them now, and that's where the additional income is coming from, and that's how they're able to make their payment. Don't put your borrowers in something that they can't afford on paper without having supporting documentation. That's not a RESPA violation, but it could create more issues for you down the line if you don't have something supporting that information or supporting that change.
Now, if a lender requires you to use a specific title company, is that considered a violation?
A lender can't make you use a particular title company. That's one of the services that you can choose as a borrower for yourself.
Right, but I've seen it where if some sellers will require that you use specific servicing or title companies in order to purchase their notes. Is that a violation, or is that something they can do?
It's not a violation of RESPA when you're talking about buying notes. It's a violation to the consumer and the borrower or the homeowner if you're trying to force them to use a particular service that they're paying for. So the other thing I want to talk to you guys about, for those of you who are doing seller financing and charging fees, I'm just kind of trying to tell you guys to stay off the radar. So sometimes when you're doing seller financing, you're charging like an application fee. An application fee versus pulling credit fee is two different fees. And technically, unless you go all the way through with the process, that application fee, if they give you money for an application fee, not running credit, but an application fee for you to take your time to look at that application, you're not legally able to charge that fee. You got to give that money back to them. I hope that's clear. If you're pulling credit and that's a fee that you actually are going to charge in your transaction, you are legally allowed to charge that fee and collect that fee prior to closing. But if you are charging an application fee, some form of processing fee, some form of origination fee, whatever you want to call it when you're doing seller financing, and they don't close, that fee is not, you're not able to keep that fee. You have to give it back. And if you think that you can get away with it and not give it back, let somebody file a complaint on you about doing origination. And you probably aren't licensed to do origination anyways. That's a problem.
But if the loan does go through, they can charge for it.
You can charge for it, but you need to also make sure that you're not. So that's where TILA and TRID come into place. There are some boundaries on high cost loans on what you're allowed to charge and what you're not allowed to charge.
Okay. So I just want to remind everybody, if you have a question, please raise your hand. We do have one hand raised right now by Peter. I'm going to go ahead and bring him on live. Peter, go ahead and unmute yourself. There you go. Hi, Peter.
Hi, thanks for taking my question. I have a situation with a couple of loans that I bought in a pool where the hello goodbye letters, without getting into a lot of boring detail, weren't properly sent. Is there any provision within RESPA to kind of recover yourself in good standing? Or once you miss the 15 days, is that it forever? You can never repent and be forgiven and go forward and sin no more.
Okay, so because we are on, and you have a situation, because we are on live on multiple outlets today, I don't want to answer your question as far as me feeling like I'm giving you advice. So sometimes if there's a date wrong, if there's something wrong, you can send a corrective letter. You can send a correction letter. I don't know what the case is in reference to what's wrong with the letters, but if the letters were wrong, you can basically acknowledge that the letter was wrong and resend it. If the letter was never sent, from whoever the seller was, I would ask for documentation on why the letter was not sent, why the goodbye letter wasn't sent, and who's doing the servicing on these loans. You don't have to.
I'm sorry, did you ask me a question?
Yeah, who do you have a I don't want to know who the servicer is. I want to know, do you have a servicer for these loans, or are you self-servicing?
They were with a servicer and I'm now self-servicing.
So did they send a goodbye letter when they transferred servicing to you?
Yes, I neglected to send the hello letter. Should I call you offline?
Yes.
Okay, I'll do that.
Okay.
Thank you. Thank you for answering my question.
You're welcome.
Thanks for coming on, Peter.
Joe, somebody put something in the chat, and I would feel more comfortable with you reading that than versus
Sure.
me again.
Sure. Is the max interest rate you can charge a borrower governed by the state usury law?
What are you in referencing to? Are you referencing a modification? Are you referencing a seller finance loan?
If you can answer that question, Sri, or maybe come on live to ask the question, that would be great.
So a modification. So let's talk about a modification. The intent of a modification is to put the borrower in a better position than they were in before they went into default. Increasing the interest rate in this day and age would not look good for an investor. If it's a primary residence. If it's an investment property, that's a whole different ballgame. And then with seller financing in place, with the regulators really cracking down and trying to kind of control that industry too. I don't recommend over 8%.
Sabrina, hi Sabrina, this is Sri. So
I-
I have some loans where the current interest rate is 3%. After it was modified, borrower is not paying. And in some instances, what happened is they have paid off the senior. They don't have a senior loan anymore.
Mhm.
So I don't know if I can increase the interest rate now. And the other thing is, I wasn't sure, maybe I didn't hear it clearly. When you said the interest rate is determined by TILA, but I was under the assumption that the usury law usually determines how much interest rate can you actually charge in that particular state. And that's state law. Is that correct or no?
So there are state and federal laws, but again, the state laws mirror federal law. Not totally, but a lot of times state laws mirror federal laws, but they have sometimes some quirky things. Just think about some states have the right to redeem. They have redemption states after foreclosure, which is 6 months, but that's not really how most of the United States works. It just depends. So in origination, it's considered a high cost loan. And so the high cost loans, off the top of my head, I can't tell you what the percentage is, but you have to be, you just can't legally charge I'll say the 12, 13% interest rate that some of us
Yeah,
like.
I'm not going over 8. I'm not going over
You're not
8.
going over 8.
What I'm saying is,
So
originally
so my question is, in order to increase the interest rate, you have to have the borrower in agreement with whatever you're getting ready to do. Are you in communication?
Yeah. So I get the process that I follow is I ask them to provide a financial package with the hardship and everything. And I see they have enough income and they have disclosed that they paid off the first, they don't have a first mortgage. This is a situation. I don't want to talk about a specific case because it's an open forum, but in their financial package, they have clearly stated all other liens on that particular subject property have been paid off. This was the only lien, and they haven't paid in 8 years. So in the meantime, they paid off the first. So now this was modified and they didn't pay and they thought they don't have to pay anymore. As is the case most of the times. This was the second lien. Now it got into first position. And when the loan was last modified, when they made, and the last payment they made was at 2.4%. And at that rate, if I'm paying the servicing fee per month, I'm not going to make anything on that from a return perspective. So increasing the interest rate than what it was in the loan mod, is it allowed or not, is what I don't know. My attorney said, yeah, sure, you can increase it as long as the borrower is okay. Obviously, if the borrower doesn't agree, there's no loan mod in place. But,
right, and that's kind of where I was going with it. If they don't agree,
yeah.
But so help me understand, why do you feel like what's your loan balance?
Loan balance is $83,000.
So even at 2 to 3%, based off of what you paid for the loan, what you pay for the loan?
I paid 48 cents.
Okay, you paid 28 cents on the dollar. And even if you put them into a new 15-year term loan at let's just say 3%, why do you feel like you're not making any money?
Well, my cost of capital is much higher to cover that.
Okay. So, because of your cost of capital. I wanted a clarification on why
Right.
you felt like you weren't going to make any money.
It's my cost of capital, basically.
Because it's your cost of capital. Okay. Makes sense. So based off of their financials, do they have the ability to put down a down payment?
They do, but they are saying we would rather get on a payment plan. I generally don't approve loan mods without a down payment. But I'm still in the discussion phase. I'm trying to, but at the same time, I want to see what interest rate can I legally charge. If they cannot afford, they don't accept it. But they have income, they can, based on their income, they can easily afford more than 1,000, and the rents are 1,400 in that market.
Okay.
So, you know, even if a foreclose, if they were to move, they would have to pay 1,400 to live somewhere.
So do you have have you thought of any type of incentive plan? Because
Yeah, of course. Yeah, if they put a down payment, I'm going to match that amount.
okay. And even, you know, like so many down, you know, I know you've been doing this for a long time, but even to the point of a number of payments a month, you know, for so many months.
Yeah.
So let's say if they make 6 payments on time, you'll give them this back
Okay.
in reference to that. And then
So-
the other thing that I would tell you is that maybe you do some form of a step mod where
Okay.
the interest rate starts here, it goes here. It goes up over time because we really don't know what the market's going to do in reference to interest rates. But
Right.
what that'll do is also kind of give them some type of incentive to
Okay.
get their loan refinanced once they actually have paid you on time for 6 months to a year.
Okay. Okay. All right.
So
Makes sense.
that's kind of how I would make it a win-win, and then a way to possibly be able to capture your money back, since you said the cost of capital. That's a
Right.
way for you to be able to recover your cost of capital by doing
Okay.
some form of a step mod or forbearance.
Okay. Thank you. Thank you, Saprina. Appreciate it.
You're welcome.
All right, it looks like we're coming up to the tail end of we've actually surpassed our 45 minutes that we were going to do today. But if there are any last minute questions, please ask them now. Otherwise, we're going to try to wrap this up. And before we do that, while you guys are thinking of your questions, one of the things I wanted to bring up was this spreadsheet that we had started about a couple months ago. And it's related to state relief funds. And this is, everybody has access to this. In fact, I can go ahead and share this on the chat window right now. Let me see. Copy link. So I'm gonna share this on the chat window. If you guys come across any information related to relief funds for COVID or whatever, related to the residential market, please post it here. That way everybody can benefit from this. This is an open spreadsheet for everybody to use. Even if you don't have information, you can come here and look it up. We have right now in Maryland, Ohio, Oregon, and one other,
Virginia.
we have information in here that takes you to links that go to, you know, the specific programs related to each of these relief funds, information about who to call, contacts, and so forth. So please take some time if you know of any and fill this out. And again, you all should have access to this. And if you don't, just give us an email or a call and we can set you up. That's
So
all.
one of the things, you guys, the reason why we came up with this is, you know, when the hardest hit funds was available for us after the mortgage crisis, we were able to, you know, really capture quite a bit of money, some of us in the industry, from the hardest hit funds. And this is really no different. A lot of us are wanting to move forward with foreclosure, and because of the moratoriums, we really can't. But if we actually have our borrowers applying for this money, this is a way that they can actually help themselves, and they can actually put some money in our pocket where we can kind of get them back on track. So I think it's really important that we all share, you know, keep everyone informed. And I have gotten money in Ohio from these funds, quite a bit of money in January from delinquent rent payments and some of the seller finance deals that I've done. So it's real. You know, you just have to give some information as a lender. And what I mean by that is you have to you have to complete a tax form for them to actually issue you a 1099 at the end of the year, showing that they actually gave you that money. And, you know, if you're doing business properly anyways, it's not a big deal. But this is something that I think that would really, really help us and the struggling investors who maybe only have 3 or 4 loans, who need to get those loans performing. This is a great way to be able to help your borrowers and also possibly change your note game.
Mm-hmm. I also posted a couple of links up there. I realized I posted them earlier, but it only went to us, the panelists, not everybody else. So you should have 4 links now on the chat window. Copy those links. Most of them pertain to RESPA. One of them goes directly to the new 4506C form that's going to replace the 4506T form that we were talking about earlier. So copy those, keep them, and if you guys have questions about them in the future, let me know, and I can direct you to them. So I can see that we don't have any additional questions here, Saprina. So with that, we're going to try to wrap this up. Again, we're trying to keep this to 45 minutes. I know that we went to an hour today, but there's a lot of information to cover regarding RESPA. So next week, what are we going to focus on next week, Saprina?
I don't know. We'll do some advertising this week, but probably it will be some form of a part 2 on RESPA. Probably some form of a follow-up, and then just kind of going maybe just a little bit deeper. Maybe giving an example of a hello letter, a goodbye letter, and going over the fines and penalties, and also giving you guys, again, the hard numbers of what you could actually keep in reserve for RESPA. I mean, not for RESPA, for escrow, according to RESPA. I also want you guys to also make sure that you are having an escrow analysis done on your files on an annual basis. So that's something that the servicer makes you pay for, and don't be cheap and not pay for it, because you could be creating a violation unknowingly. And generally, if you don't allow the servicer to run the escrow analysis, they won't do it. But I think that it's really important, if you have files that are escrowed, let the analysis be done. Please, 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 I'm begging you. I want to thank you guys for taking time out on a Saturday to be with me and Joe. I really appreciate your continued support. Again, I got a few cards in the mail this week. So again, I still want to say thank you guys for your continued love and support during my hardship and my hard time. So I appreciate you guys. And I look forward to seeing you guys next week on part 2 for RESPA.
Absolutely. And Saprina, you know that you can always reach out to any one of us. And I know that I don't just talk for myself, but for anybody that's on these calls. If you ever need anything, anything really. So with that, I want to, again, thank you, Saprina, for being here with us every week and sharing your experience and all of the detail that you get into on note investing and investing in general. And want to thank everybody for coming again. We will see you next Thursday. If anybody wants to come to our Monday IPA meeting, we have one at 6 o'clock. IPA is our ideal property analyzer. And basically you can analyze any notes, understand the numbers and exit strategies, look at timing, look at capital expenditures within those exit strategies within like 2 or 3 minutes. So if you're interested in any kind of tool like that, show up 6 o'clock on Monday and we'll do
what time zone? What time zone? You keep forgetting that we don't have just California people on this call anymore.
Yeah, I know. It's Pacific Standard Time. So that actually makes it pretty late on the East Coast. We may be changing that time frame in the future, but I haven't had any specific plans as of yet. But if you do want to know more information about it, we will be posting live YouTube webinars from that session, just like we are going to do from this session. So don't feel like you're going to miss out or anything. And then there's also a YouTube channel that shows you how to use it in different situations as well. So hope to see you guys Monday and next week on Saturday. And with that, stay safe and be good.
All right. Bye, you guys.
Take care, everybody.
Hey, Joe, I have a coaching session at 2 o'clock. So I got to jump, but I'll circle back with you when I get in the car.
Okay,
At
sounds good.